Margaret is 68 years old. She retired from teaching elementary school in North Carolina after 30 years. She lives on a teacher's pension, Social Security, and a small IRA she built up on the side. Every year she pays a woman at the strip mall tax office $180 to file her return. Last April, Margaret owed $1,100 in federal income tax. She wrote the check, stuck it in the envelope, and did not think about it again until I showed her something that made her sit down. 5 separate provisions in the tax code were designed specifically for someone in Margaret's exact situation. Every single one of them was missing from her return. Not because Margaret did anything wrong, not because she was trying to get away with something, because no one, not her preparer, not the IRS, not a single person in her life, ever told her these existed. And Margaret, like millions of retirees over 65 right now, has been handing the IRS money she does not owe every single April without knowing it. Today I am going to walk you through all 5. Every dollar amount, every form number, every qualification. This video is for educational purposes only and is not tax or financial advice. Please consult a qualified tax professional before making any decisions about your specific situation. My name is Joshua. This is Senior Benefits Decoded. Every week I walk through the Social Security rules, the Medicare changes, and the tax provisions that directly affect retirees over 65. If no one else is explaining these things to you, I will. Hit the subscribe button right now and turn on notifications so you never miss a video. Here is what makes this list different from what you will see on most channels. These are not strategies for wealthy people with trust funds and financial advisors on speed dial. These are provisions the IRS built directly into the tax code for ordinary retirees living on pensions, Social Security, and modest savings. Most of them are automatic once someone knows to look for them. And the reason most retirees never see them on their return is not that they do not qualify. It is that the person filing their taxes never checked. Tax break number 1. The additional standard deduction for age 65 and older. This is the most basic one on the list and somehow still the most missed. The moment you turn 65, the IRS increases your standard deduction above and beyond what every other taxpayer in America receives. For the 2026 tax year, that additional amount is $2,050 for single filers and $1,650 per qualifying spouse for married couples filing jointly. If both spouses are 65 or older, that is an extra $3,300 sitting on top of your already higher standard deduction. Now, most people whose preparer enters their age correctly receive this deduction automatically. But here is what I want you to understand. The number of returns where the age box is simply not checked is far higher than anyone admits. If you switched preparers in the last 3 years, if you used new tax software for the first time, if someone filed your return in a hurry during the last week of April, this is worth pulling out your return and checking right now. And here is something almost no one talks about. The same additional deduction applies if you are legally blind. If you are 65 and legally blind, you get 2 separate additions to your standard deduction. They stack. For a single filer who is both 65 and legally blind, that is an extra $4,100 on top of the base deduction. I have heard from viewers who had documented vision impairments for years, and the blindness box was never checked on a single return. That is money left on the table every April for no reason. Tax break number 2, the senior bonus deduction. This one is brand new, and it is the reason I am making this video right now. The One Big Beautiful Bill Act, signed on July 4, 2025, created an entirely new deduction for Americans aged 65 and older. It is called the Senior Bonus Deduction, and it is separate from everything I just described in tax break number 1. If you are 65 or older, you can deduct an additional $6,000 from your taxable income. If you are married filing jointly and both spouses are 65 or older, that doubles to $12,000. This deduction is unique because you can claim it whether you take the standard deduction or whether you itemize. That matters because most retirees on fixed incomes do not itemize. This applies to you regardless. The income limits are $75,000 for single filers and $150,000 for married couples filing jointly. Below those numbers, you get the full deduction. Above them, it phases out at a rate of 6% per dollar over the threshold. For a single filer, it disappears completely at $175,000. For a married couple, it is gone at $250,000. But most retirees living on Social Security and a pension are well below those limits. You claim it on a brand new form called Schedule 1A, attached to your Form 1040 or 1040SR. And this is critical. This deduction is available only for tax years 2025 through 2028. After 2028, it is gone unless Congress extends it. That is a 4-year window. If you are 65 or older right now and you do not claim this for every year it exists, you are giving up as much as $24,000 in deductions over 4 years. Let me show you what tax breaks 1 and 2 look like stacked together for a real person. Take a married couple, both 67, both living on Social Security and a pension, with modified adjusted gross income of about $80,000. Their base standard deduction in 2026 is $32,200. Add the additional senior deduction for both spouses, $3,300. Add the new senior bonus deduction for both spouses, $12,000. Their total deduction before a single dollar of income is taxed is $47,500. For a couple with modest retirement income, that alone could wipe out most or all of their federal tax bill. And yet the IRS itself issued a public warning that not all tax software is applying the senior bonus deduction automatically. If you already filed your 2025 return without it, you can amend within 3 years using Form 1040X. Tax break number 3, the qualified charitable distribution. This one is not a deduction. It is something more powerful than a deduction, and the retirees who would benefit the most from it almost never know it exists. If you are 70 and a half years old or older, and you have a traditional IRA, you can transfer money directly from your IRA to a qualifying charity. That transfer is called a qualified charitable distribution, or QCD. The money never touches your bank account. It goes directly from your IRA custodian to the charity. And here is what makes it so valuable. The amount you transfer does not count as taxable income. It does not appear on your adjusted gross income. It does not push more of your Social Security into the taxable zone. It does not trigger IRMA Medicare surcharges 2 years from now. In 2026, you can transfer up to $111,000 per person this way. If your spouse also has their own IRA, they can transfer another $111,000. And here is the part that matters most for retirees who are already taking required minimum distributions. The QCD counts toward your RMD for the year. Let me show you why this is such a powerful tool with a specific example. Dorothy is 73 years old. She lives alone in Tennessee. She has a traditional IRA and she is required to take out roughly $12,000 this year as her required minimum distribution. She also donates $1,500 a year to her church and $300 to a local food bank. If Dorothy takes her full $12,000 RMD into her bank account and then writes checks to the church and the food bank, the entire $12,000 is taxable income on her return. Her Social Security taxation goes up. Her Medicare premiums could go up 2 years from now. But if Dorothy does a qualified charitable distribution of $1,800 directly to those 2 charities from her IRA before December 31st, That $1,800 is excluded from her taxable income entirely. She still satisfies $1,800 of her required minimum distribution. The church and the food bank get exactly the same donations they always got. But Dorothy's taxable income is $1,800 lower. At the 12% bracket, that saves her $216. And if she was near one of the Social Security taxation thresholds, it could save her significantly more by keeping more of her benefits out of the taxable zone. The only mistake retirees make with QCDs is waiting until after they withdraw the money. Once you take the RMD into your bank account, it is too late. The distribution is already taxable. The QCD must be sent directly from the IRA custodian to the charity. Call your broker or custodian, whether it is Fidelity, Vanguard, Schwab, or anyone else, and ask them specifically for a QCD distribution form. Most of them let you do this online now. The deadline is December 31st, not April 15th. December 31st. Tax break number 4, the medical expense deduction. Retirees are the single group in America most likely to benefit from this deduction, and most of them never claim it because they assume they do not itemize. Here is how it works. If your total unreimbursed medical expenses in a year exceed 7.5% of your adjusted gross income, you can deduct the portion above that threshold when you itemize on Schedule A. That 7.5% threshold is permanent law as of 2021. It is not going back to 10%. Now, what counts as a medical expense surprises almost every retiree I talk to. Medicare Part B premiums count. In 2026, that is $2,434.80 for the full year per person. Medicare Part D premiums count. Medigap supplemental insurance premiums count. Long-term care insurance premiums count up to age-based limits. For someone aged 71 or older in 2026, the deductible limit on long-term care insurance premiums is approximately $5,960 per person. Dental work counts, hearing aids count, and Medicare does not cover hearing aids, so the entire out-of-pocket cost, which can be $3,000 to $7,000, is deductible. Vision exams and prescription eyewear count. Modifications to your home made for medical reasons, grab bars, wheelchair ramps, stair lifts, all deductible. Even mileage driven to and from medical appointments counts at 21 cents per mile. Let me show you why this matters specifically for retirees. Say you have a pension of $45,000 and Social Security of $20,000. Your adjusted gross income might be around $50,000. 7.5% of $50,000 is $3,750. Now think about what a retiree on Medicare actually spends in a year. Part B premiums alone are $2,434. Add a Part D drug plan. Add a Medigap policy. That alone for many retirees is $5,000 to $6,000 before a single doctor visit or prescription. Add one dental procedure. Add a pair of hearing aids. Add prescription copays and specialist visits. By the time you add it all up, a retiree with modest income on Medicare is often well above that 7.5% floor, and every dollar above it is a deduction. The mistake retirees make is assuming they cannot itemize because the standard deduction is so high. And yes, with the new senior bonus deduction adding up to $12,000 for a qualifying couple, the bar for itemizing is higher than it used to be. But if you had a year with a major dental procedure, new hearing aids, or significant long-term care expenses, you need to run both scenarios, standard deduction and itemized, every single year. Do not let anyone file your return on autopilot. Tax break number 5, the credit for the elderly or disabled. This is the most overlooked tax break on this entire list. It has existed in the tax code for decades. It applies to millions of retirees right now, and the vast majority of people who qualify for it have never seen it on their return. Not once. Here is how it works. If you are 65 or older, or under 65 and retired on permanent and total disability with taxable disability income, you may qualify for a non-refundable tax credit. Not a deduction, a credit. A dollar-for-dollar reduction in what you actually owe. The credit is worth between $375 and $1,125. You claim it using Schedule R attached to your Form 1040. The catch is the income limits. For single filers, your adjusted gross income must be below $17,500. For married couples filing jointly where both spouses qualify, the limit is $25,000. Those are low thresholds. This is designed for retirees with very modest incomes who are still paying some federal tax. But think about who that includes. A retired school bus driver living primarily on Social Security with a small pension. A widowed nurse whose household income dropped significantly when her husband passed. A retiree whose only income is Social Security and a tiny IRA distribution. These are the exact people this credit was built for. And in most cases, their preparer either does not know the credit exists or assumes the income is too high without ever running the math. The credit is calculated on Schedule R and then transferred to Schedule 3 on your Form 1040. And here is something most people do not realize. The IRS will actually calculate it for you if you fill in the right information and check the appropriate box in Part 1 of Schedule R. You do not have to do the math yourself. If you are in the income range where this credit applies, it can wipe out your entire federal tax bill for the year. Let me bring this all back to Margaret. The retired teacher in North Carolina I told you about at the beginning. 30 years in the classroom. $1,100 owed last April that she should not have owed. Here is what was missing from her return. The additional standard deduction for age 65, $2,050, not on the return. The new senior bonus deduction, $6,000, not on the return. Medicare Part B and Part D premium she had been paying all year, over $3,000, which combined with a dental crown and new prescription glasses would have pushed her well over the 7.5% threshold and made itemizing worth exploring. Never discussed. And the credit for the elderly or disabled, which at her income level could have applied. Never checked. Schedule R was not attached to her return. None of these required Margaret to do anything complicated. None of them required a financial advisor or a lawyer or a special strategy. They required one thing: someone who knew to look for them. That is the only difference between a retiree who keeps every dollar they are owed and one who sends extra money to the IRS every April without knowing it. Here is your action checklist. 5 things to do before you file or amend. Step 1. Pull out your 2025 tax return. Look at your Form 1040. Verify that the age 65 or older box is checked for you and your spouse. If either of you is legally blind, verify that box is also checked. These are the easiest $200 to $3,000 corrections in the entire tax code. Step 2. Look for Schedule 1A attached to your return. If it is not there and you were 65 or older in 2025 with modified adjusted gross income under $75,000 single or $150,000 joint, you may have missed the senior bonus deduction. Talk to a tax professional about filing an amended return using Form 1040X. You have 3 years to amend. Step 3. If you are 70 and a half or older and you have a traditional IRA and you donate to any charity, call your IRA custodian this week and ask about setting up a qualified charitable distribution before your next RMD deadline of December 31st. Step 4. Add up everything you spent on Medicare premiums, supplemental insurance, dental, vision, hearing aids, prescriptions, and medical-related mileage this year. Then take your expected adjusted gross income and multiply it by 7.5%. If your medical spending is anywhere near that number, run both scenarios, standard deduction and itemized, before you file. Step 5. If your adjusted gross income is under $17,500 as a single filer, or under $25,000 as a married couple, ask your preparer specifically about Schedule R and the credit for the elderly or disabled. If they look at you blankly, find someone who knows what you are talking about. Margaret filed an amended return for 2025. She received $932 back from the IRS. It took one phone call to a new preparer and 2 weeks of waiting. That is money she had already given away that was always hers. This is Joshua, Senior Benefits Decoded. If this video helped you find something your preparer missed, hit the like button right now. Subscribe and turn on the bell so you never miss a video. And send this to every retiree you know who is over 65 and files their own taxes, or uses a preparer who has never mentioned any of these 5 things. Tell me in the comments which of these 5 did you already know about, and which one surprised you. I read every single comment, and the situations that come up the most become future videos. This is Joshua, Senior Benefits Decoded. I will see you in the next one.